Lenders calculate the amount you can qualify to borrow on a mortgage using what's called a debt-to-income ratio, or DTI. The debt-to-income ratio allowed varies depending on the loan, and in this video I'm going to walk you through the DTI permitted under each loan type: conventional, FHA, VA, USDA, and jumbo. This video is part 4 of a playlist that covers everything you could possibly want to know about debt-to-income ratios: how they're figured, what's counted as debt and as income, how lenders use your DTI, and how to manage your DTI to get the best possible terms on the best possible loan. Check out the full playlist, and if you find it helpful, I would love it if you took a moment to like and subscribe. It makes me happy to know you learned something helpful and got value from the information I'm sharing. So as a refresher, or if you didn't watch the other videos in the playlist already, your lender is going to calculate your debt-to-income ratio 2 ways. There's a front debt-to-income ratio, which is your housing expense divided by your income, and a back debt-to-income ratio, which is your housing expense plus your other debts divided by your income. And every loan program has a rule book your lender follows. These rule books are called guidelines, and guidelines for every loan program include maximum debt-to-income ratios, or really, I should say, multiple maximum debt-to-income ratios. Most loan programs have multiple DTI limits applicable based on different methods of underwriting. Now, underwriting is the process by which your lender holds your loan up against the guidelines for the loan you want. And when I started in the mortgage industry way back when, underwriting was done entirely by human beings. They were really lovely people who hunkered over their desks, piled with old school paper files, and thumbed through these giant 3-ring binders full of guidelines. They also smoked a lot. I think I learned most of what I probably picked up in my first several years of mortgage lending asking underwriters questions while they were on their smoking breaks out by the front door. Then in 1997, Fannie Mae and Freddie Mac introduced a revolutionary new idea, or really I should say a new technology. They created automated underwriting systems, or what we now call AUS. And these automated systems basically use an algorithm to assess all the aspects of each loan and determine if it fits a target level of risk. These automated systems actually allow a little more nuanced approach to underwriting. So let's say you have so-so credit, but you can pay a really big down payment. An algorithm might decide that your down payment offsets your iffy credit and grant approval that a human underwriter wouldn't or couldn't grant. And this type of underwriting has become really ubiquitous. These days, it's actually unusual for a mortgage to be underwritten without some kind of automated underwriting system somewhere in the mix. And just to run through the names so you know them, Fannie Mae calls their automated underwriting system Desktop Underwriter, or DU for short. Freddie Mac used to call theirs Loan Prospector, or LP, but at some point they changed that to Loan Product Advisor, or LPA, and FHA and VA have embedded their systems into DU and LPA. FHA calls theirs Total Mortgage Scorecard. Total is an acronym for Technology Open to Approved Lenders. We just love acronyms in lending. And although USDA has the cutest name for their AUS, it's called GUS, which stands for Guaranteed Underwriting System. GUS is actually a little bit of a meanie, as we'll talk about. Now, this alphabet soup hasn't entirely replaced humans. When automated underwriting gives a loan an acceptable risk grade, a human underwriter still reviews it to verify that the software based its findings on good data, that the input, income, and assets and other information are accurate and are supported by the appropriate documentation that you provided. But if the algorithm doesn't sign off, or if the underwriter notices something the software couldn't evaluate, or maybe the decision was based on bad data, as programmers like to say, garbage in, garbage out, then the loan is referred for old school manual underwriting. So the automated systems can kind of sign off on a loan, but they don't deny it. It still goes to a human underwriter. That's what the referred is about. And just like back in the day, then a human holds the application up against loan guidelines and decides if it fits. Now, where this is relevant in our conversation about debt to income ratios is that automated underwriting systems are programmed to allow higher debt to income ratios than human underwriters are allowed to approve. Manually underwritten conventional loans, those loans funded through Fannie Mae and Freddie Mac that don't go through an automated system, are limited to 36% debt to income ratio, where Fannie Mae's automated underwriting, DU, will go to 49.99%, and Freddie Mac's LPA goes even higher to 50.49%. FHA loans, manually underwritten, require a 31% front ratio, remember that's the housing expense only, and then 43% total DTI, but FHA loans approved using total can go all the way to 47% front and 57% back. VA requires a 41% DTI for manual files, but I have seen VA loans that go to 70%, even higher than 70% using automated underwriting. And USDA loans are a little bit of an outlier in that they have very tight debt to income ratio requirements, 29% front, that's the housing expense, and 41% back for manually underwritten loans. And that's only expanded to 32% front and 44% back for loans approved by GUS. But GUS is, as I mentioned, kind of a meanie and has the highest refer rate of any AUS. And I want to come back to those crazy high debt to income ratios that VA allows because, does spending 70% of your pre-tax income on just your house payment, credit cards, car and student loans sound a bit excessive? What about your income taxes and groceries and gas, and maybe you want to go out for dinner or see a movie or take a vacation once in a while? Now, the very high DTIs that VA loans allowed are a little less outrageous than they sound because the VA applies one additional means test. Before approving a VA loan, lenders are required to calculate a residual income. After you pay your mortgage and other bills, your state and federal income taxes, your child care, your utilities, and you set aside some money to maintain your house, you have to have a minimum amount of net income left over per person in your household. So an extra high debt to income ratio on a VA loan is only allowed if you also have enough residual income. So how do these differences in DTI actually look in the real world? Well, Fannie Mae rules allow 36% DTI for manually underwritten mortgages, but basically 50% using automated underwriting. So what does that extra 14% of wiggle room mean in your house hunt? The math is pretty simple. Multiply your pre-tax income by 14%, and that's how much bigger your house payment could be using automated versus manual underwriting. So let's say you earn $10,000 a month. $10,000 times 14% equals $1,400 of additional potential mortgage payment. At a 6.5% interest rate, $1,400 a month equals an additional $220,000 of loan amount. That is a pretty big difference. However, not every person is going to be approved for a 50% debt to income ratio. The automated underwriting algorithm is looking at a combination of factors, what lenders call layers of risk. If you have so-so credit and you make a very low down payment, and if you won't have any savings left over after you buy your house, AUS may limit your maximum debt to income ratio to something lower than those maximum amounts that I mentioned before. Because these differences can be really significant, my team and I work really closely with our clients to leverage automated underwriting to the maximum extent possible. And I should say, most of our clients don't actually wind up borrowing at the limit of their debt to income ratio, but starting the process with a greater amount of flexibility in your DTI can still be valuable. We want to keep as many options open to you as possible as you kick off your house hunt. And because very few things in lending are entirely black and white, let's muddy the waters with one more concept. Manual underwriting guidelines often have some built-in flexibility that gives underwriters some discretion to approve a higher debt-to-income ratio if we can demonstrate something called compensating factors. Compensating factors are things that don't directly impact your DTI itself. They're not going into the math, but they mitigate the risk profile your loan presents. Fannie, Freddie, FHA, VA, and USDA all allow expanded debt-to-income ratios for manually underwritten loans with comp factors. And lots of things can be considered a compensating factor. FHA's official list includes having 3 months of your new mortgage payment, the equivalent of that, left over in your own savings, not gifts, after closing, having additional income that isn't being counted in your debt-to-income ratio. Maybe you have a part-time job, but you haven't had it long enough that we can use it, or your income's been going up and we're only counting a more conservative number. Also having potential for increased income in the future or potential for professional advancement if you're new in your career is a comp factor for FHA. And then borrowing from the VA for this idea, FHA will actually consider residual income to be a compensating factor too. If you've got a nice amount of money left over every month after you've paid all your bills. And if your new home that you're buying has a high energy efficiency score, the lower utility bills you'll be paying can be considered a comp factor too. The VA list of comp factors expands to add a few more things. They'll take into account excellent credit, long-term stable employment, a minimal increase in housing expense, military benefits that were not being counted as official income, and this would be like your military benefits for education, for example. We can't count that as income, but of course it exists, you're still receiving it. And prior homeownership experience is a VA comp factor. Any tax benefits you're getting for homeownership are comp factors for VA too. But true to form, the guidelines for USDA will actually only let us start talking about or consider compensating factors if you have a credit score that's at least 680, and then their list of comp factors is really specific and really short. You either need to have at least 3 months of your new mortgage payment left over in savings after closing, or a minimum of 2 years tenure at your current job. They will let us use 2 years of retirement or Social Security income as a comp factor, but we can't count self-employment. You could be self-employed for 20 years instead of 2, and that isn't one of those comp factors. Now, if you're keeping score at home, you probably noticed I haven't talked about jumbo loans yet. And jumbo loans are those that are bigger than the threshold that Fannie Mae and Freddie Mac set annually, and they are just so incredibly varied. Some are nearly as restrictive as USDA when it comes to debt-to-income ratios. Others will allow debt-to-income ratios as high as 50%. On an exception basis, sometimes even over 50%. And although a significant number of jumbo loans are manually underwritten, little by little, jumbo investors are creating their own automated risk assessment tools, their own AUSs, or in a lot of cases, just piggybacking on Fannie and Freddie and using their AUS systems. Now, if you started at the beginning of the playlist, we have come a long way. We've calculated your debt-to-income ratio. We've taken a deep dive into debt and income, both of those sides of the equation, and we've figured out how your DTI can play out under different loan programs, but how does all of this play out in the lending process itself? I'll answer this question in the next video.